This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Jess, nice finishing out the day with some pretty good moves to the upside here in the equity markets.
And then looking ahead to tomorrow, jobs report.
Yes,
so
exactly.
It is obviously, we've talked a lot about the blackout period for Fed speakers this week, but we do have the jobs report coming tomorrow. So that will be very much on investors' radars. Also, average hourly earnings will be a part of that report, which we know Fed Chair Jerome Powell and other policymakers are going to watch very closely ahead of their decision next Wednesday. And also ahead of that decision on Wednesday, too, we have CPI next Tuesday,
Yep.
Paul. So still a number of indicators ahead of the Fed's decision. So things we need to keep our eyes on.
Yeah, and just taking a look at the non-farm payrolls, 185,000 is a consensus tomorrow, and that's up from 150,000 the prior period. So we'll keep that in mind. And average hourly earnings on a year-over-year basis, 4% increase, be a little bit of a decline from 4.1% last period, but still some pretty solid numbers, a little bit slower than what we had seen, but the unemployment rate, 3.9% is kind of the forecast there, and that sounds pretty good. But Michael McKee, he looks at it a little bit more, peels a little bit more of the layers of that onion.
He's the best to do it.
Exactly, right. So Michael, what are you going to be looking at tomorrow? And, when we get all this data on just kind of the labor market in general?
Well, I think the market is going to focus, assuming we get a somewhere near consensus number for job creation. We'll focus on unemployment and whether that goes up and why it did, if it does. Are more people coming into the labor force, which is not necessarily a bad thing, or are we starting to let people go? That'll be the primary question. And then people will be looking at average hourly earnings because they want to see if earnings growth is slowing down enough that the Fed doesn't have to be worried about it continuing to contribute to inflation. We're forecast to hit 4% on a year-over-year basis, and the Fed thinks sustainable is about 3 to 3.5. So we're getting close.
Yep.
So those are kind of the numbers that most people will be focusing on tomorrow.
Will that report adjust anything for the Fed's decision next week, or do you feel like that's pretty much already a done deal and it's more of just the forecast, the quarterly forecast, and obviously the dot plots are going to come with that decision?
Yeah, it's pretty much a done deal. The Fed, it would take something going horribly wrong tomorrow, and I'd be back on this show trying to explain it at this time tomorrow. The Fed has all but signaled they're done raising rates. It would require a lot for them to do something at this meeting, and probably not as much in tomorrow's report as it would be the CPI next week.
Right, on Tuesday.
So I don't think you're going to have to worry about the Fed out of tomorrow's report. It'll spur conversations about next year and when the Fed might or might not cut rates, but not anything for next week.
So the Fed, I'm not sure what the right word is, but I guess they're prepared for the unemployment rate to inch a little bit higher. Is there a point where it gets beyond where they're comfortable? Like, is it like have a 5 handle and then they said, oh boy, and then they really need to be maybe a little bit more aggressive here?
Well, they were forecasting 4.1% by the end of the year, so we're sort of in the range and may come in lower than that. But if it got above, if we had a jump like we did a couple of months ago of about 0.3 and we went up to 4.1% from 3.9, or we went up to 4.2, that would get their attention. If we got over 4.5, that would start to raise concerns there. The speed of it and the composition of it would also matter to the Fed, and what else is happening with inflation. They are expecting unemployment to rise because their job is to squish down on demand.
Yep.
And
CFA
that,
time.
in theory, should lead to fewer employees needed, and so unemployment rises. But the speed would concern them if it was quick, and if it started to get too high, of course, by that time they would probably already be acting.
I'm glad you're here because something I've been thinking about is the rotation for Fed voting members each year. So Austin Goolsbee, Patrick Harker, Lawyer Logan, and then Neil Kashkari currently voting members this year, but won't be next year. So then we're going to have Loretta Mester, Thomas Barkin, Raphael Bostic, and then Mary Daly will come back as voting members for next year. How do you think this, when you have those rotations, because in recent years, especially as inflation was very elevated, it seemed like everybody had to have these unanimous votes as far as trying to tame inflation. But when you're going into a year and stock investors are betting that they're going to be rate cuts, when you have a rotation changing like this, how do you view that? Are things really going to be that different? Could that potentially change the expectations for how soon or later rate cuts could potentially come?
I think people make too much of that. The people who are coming on are generally centrists, with the exception of Loretta Mester, and she's leaving in June. So I don't know that we'll see a lot of pushback. You're right, we get more unanimity when it's very obvious what the Fed should be doing, which for the last year or so has been very obvious that they should be raising rates. And when you get into a situation where it's a close call, should we hold or should we cut rates, then you could see a dissent or two from whatever it is the Fed decides to do. But I think we're not going to see any major splits among them. They're going to move slowly, even unless we have a recession. They're going to move slowly. So even if they do, it's not going to force a lot of people into an uncomfortable vote.
So the University of Michigan, some good football players there. But they also
so they'll tell you.
Yes. And they also have some good economic data. And they put that out, and expectations and inflation outlook and things like that. Do economists, do they care? Does the market really care about some of this data?
The market doesn't really care about and the Fed doesn't really care about the sentiment indicator, how people are feeling. Alan Greenspan summed it up very well years ago when he said, we watch what they do, not what they say, talking about consumers. The expectations for inflation have become moderately more important because the Fed has made a big deal out of inflation expectations being the anchor for inflation, and they don't want to see expectations rise too much, both on the consumer or market side. Market side right now is looking at 2 to 2.5% inflation out 4 or 5 years, which is perfect for the Fed. But Americans are looking at 4.5%. Now, the sentiment indexes, people always overrate what inflation is, and if you go ask any American, they'll probably tell you now it's 6 or 7%, just because they don't know what inflation is. But even if you allow for that, it's a little bit higher than both the Fed would like to see and that you would expect, given the fact that food prices have stabilized, gasoline prices are way down, and yet people are still thinking there's a lot of inflation. They're looking at price levels rather than the rate of change, which the Fed looks at. So there is kind of a difference there. But as long as people don't start thinking inflation is going to go so high they have to march into the boss's office and ask for more money, which, of course, we would never do here.
No. Never.
No, never.
Hey, I was out gallivanting in the city, Midtown, yesterday evening.
For your birthday.
Yes. People were
I did
out,
not know.
Big birthday.
People were out and about,
Wow.
spending. Streets were packed. You couldn't get near the Christmas tree at Rockefeller Center. I mean, people were out. It feels like the consumer is in pretty good shape. I don't know.
Well, people tell pollsters that the economy is lousy, but my situation is good. People have jobs. I mean, we have 97% employment. And so it isn't a terrible time, and there's more and more talk of this. Is like poor Joe Biden. I mean, he's presiding over a good economy, and people don't believe it for a variety of reasons. But things aren't bad right now. So Americans on their own individually are quite happy to go out and buy Paul a hot chocolate on his birthday.
Exactly. See, that's how we roll out there. All right, Mr. McKee, thank you very much. We appreciate it. Michael McKee, international economics and policy correspondent. And Jess, I mean, again, the restaurants are packed, the bars are packed. The Fifth Avenue, you could barely walk down. I mean, that's how crazy it was.
We'll get actually an update on retail sales next Thursday, so the day after the Fed decision for the month of November. So this will give us a read, especially on the holiday spending. We already got a lot of that Cyber Monday and Black Friday data that were at records, so we know it was really strong last month, but that's going to be interesting to see what that data looks like for the consumer, Paul.
Yeah, and a shout out to the tree. The folks who did the tree
Yes!
at Rockefeller Center. It looks
It's amazing.
awesome this year. I mean, we just walked by it. It looks awesome.
We've got
always.
a tree here, too, at Bloomberg, but
Yes,
not
we do.
quite
We have
as
a very
big as
good
that
tree.
one.
So if you're around, the Bloomberg HQ, come check out our tree in our courtyard. Pretty darn cool. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Hey, Mr. Spaceman, won't you please take me along? I won't do anything wrong. Hey,
Always the best
Mr.
tunes.
Spaceman.
Paul Brennan,
Business
the
Week.
producer here.
I mean, who knew we
Picking
had that
the music
musical taste?
today.
Always. They always bring the musical game here. All right, Jess, Menton, Paul, Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. We're sitting in for Tim Stenovec and Carol Massar. Let's talk one of the really cool news items of the day. SpaceX tender offer said to boost value to $175 billion. So I guess they're going to be tendering for some of the shares owned by employees, and the tender value again implies a valuation of $175 billion. That's a lot for a space company, which is pretty cool. Katie Roof joins us. She's a VC deals reporter for Bloomberg News. She joins us on Zoom from Los Angeles. I know, Katie, you're used to numbers like this out there in in California and LA and Silicon Valley. Talk to us about what SpaceX is doing here and how this is going to work.
Sure. And so this is actually a record for a U.S. private venture-backed company, $175 billion. It's $95 a share for the tender offer. Just 6 months ago, they were valued at $150 billion. A year ago, they were valued at $137 billion. So this is a big increase for an already highly valued company. And it really is bucking the trend because, as we've seen in Silicon Valley the last couple of years, the companies are struggling to maintain their billion-dollar valuation. But people that I talk to are big believers in SpaceX.
So talk to us about sort of the issues moving forward for SpaceX, because they're in a unique situation right now.
Sure. So they have two core businesses. They have their rocket launching business, but they also have Starlink, their internet business that's satellite related. And so a lot of the investors tell me that the reason that they're investing is because they are really bullish on Starlink. It's our understanding, and we've reported, that Starlink is eventually going to be spun off of SpaceX and go public someday. And so a lot of the investors are trying to get in on that.
Do either of you know where they launched their rockets from?
No.
Boca Chica, Texas.
Wait, really?
Yes. It's literally, if you go
Boca Chica,
Texas. It's literally the most southern part of Texas. It's like right next to
I feel like I should have known this, being from South Texas.
It's unbelievable. I mean, who figures out
got me
Boca
there,
Chica?
Paul.
It's right on the border with Mexico. Apparently, they're building all this infrastructure, and they got rockets down there. And
That's amazing.
Yeah, isn't that cool?
Well, I'm going to be down there this weekend,
I think
so
you should
maybe
go
I should
check it
swing
out.
by and check this out.
Swing by Boca Chica. So, I mean, Katie, how often does it happen that a company will, I guess, give liquidity to its employees that, through these tenders?
So SpaceX does it more often than most. They've been doing it roughly every 6 months recently, but it's really a case-by-case basis with companies. Some companies don't want to do a lot of this because it makes it harder to have investor demand if they want to raise a round for the company, if there are already a lot of shares that have been available on the market. But what SpaceX is doing here is providing an opportunity for employees to go and buy that house, because if they don't sell these shares in a tender, they have to wait for an eventual IPO. Otherwise, their net worth is just on paper. So that this is really to help insiders have some liquidity, and they're able to do this because they have tremendous demand. And it goes without saying, Elon Musk, who is the founder of this business, is a very, very controversial figure. He's recently made statements that have hurt advertisers on X, formerly known as Twitter, but we see still plenty of investor demand for SpaceX.
Hey, Katie, do we know who buys these shares from the employees?
A lot of them are VCs or other high net worth individuals, accredited investors. Could be hedge funds. It could be broad groups of institutional investors, but it's a mix.
That's interesting. So what do you think is sort of the timetable kind of moving forward here as far as how all of this ends up playing out?
Well, our understanding is that they just decided on the price, or they were on the verge of deciding the price when we got a hold of it. So the tender is just getting started. It's just underway. I would imagine that they're going to try to do as much as they can before the holidays, but I'm not sure if it will formally close before the end of the year.
Katie, you're the VC deals reporter. Talk to us about your world these days. Are VC companies getting funded? If I have a really cool idea, can I go to Sand Hill Road and raise some money here? Give us a sense of what the environment is like.
Well, if you're doing an AI-related company, they're all ears, and they'll be writing you checks before you know it. But for everything else, for other than outliers like SpaceX, it's been really slow this year, particularly at the growth stages, which I cover. Sometimes at the seed stages, they're not as concerned about the broader macro environment because VCs tend to invest on a 10-year time horizon, and so they can be bullish about the future. But companies that raised in like 2021 are often considered to be overvalued because the market, you look at tech stocks, they've gone down for the most part considerably since then, and that's affected valuations throughout the whole ecosystem. So right now it's a tough time to be a startup that raised money and that wants more money, but if you're just getting started, sometimes there's room for opportunity still.
For those who don't know, Katie Roof is one of our star reporters here at Bloomberg, constantly breaking news out of Silicon Valley. From your purview being over there and what you were just walking us through, especially on the back of what happened with some of those regional bank issues back in the spring, and a lot of those tied to different Silicon Valley banks, what is it like in the mood, in the atmosphere, as far as how things have come and gone over the past 9 months since then?
So there's fewer holiday parties this year.
We were talking about that earlier.
Yes, we were.
Apparently there's a story on the terminal, more pickleball and guac, Katie.
Yeah, so my understanding in talking to some venture firms, there's still some, but some felt that it was a bad look to throw a holiday party this year. You look at their last 2 years where there have been very few IPOs. The M&A is often very disappointing prices, so they're not bringing in a lot of money, and so they felt that it looked bad for some of them to be throwing big splashy events. And Silicon Valley Bank actually used to be the sponsor of a lot of these events. Interestingly, I still see their name on some parties because they're still alive with their new owner, but wow. I would imagine that it's a different scenario than it was 2 years ago.
And are the VC funds, are they still out there fundraising, or is that also kind of slowed down?
Sure. And so I think, again, it's a split between the stages. So the earliest stages, a lot of them have had great returns and have continued to raise new funds for seed stage investing. But what you're seeing is a lot of the crossover funds, the pre-IPO investors, really got burned in this market. And so what we're seeing is some of them struggling to raise new funds or raising smaller funds or trying to change their strategy to invest in either the earlier stages of VC or just go back to investing in the public markets if that's what they were doing before.
Yeah, interesting. It's just a tough time. I think people are just uncertain. I'm just looking at the NASDAQ, still 10% off of the high. So if you're valuation sensitive, that kind of number kind of gets your attention there. Katie Roof, thanks so much for joining us. Katie Roof, VC deals reporter for Bloomberg News, joining us on Zoom from the awesome office for
Yes,
Bloomberg in
I've heard
Los
about
Angeles.
this. I gotta go visit sometime soon.
Yeah, looking very cool. It's out there in Century City. Nice part of town there, overlooking Bel Air Country Club, I believe, is the one kind of splashy. It's what you would expect from Bloomberg News in LA.
I'm still thinking about what you told me about South Texas, where the launch pad
Boca
is.
Chica, we'll go.
So I'm gonna be down in South Texas this
Go
weekend
take-
officiating a wedding. So
I don't know how you get there.
I'll figure it out.
Yeah, flying to Houston, and then I think you drive. You just keep driving. All right, we're gonna have more coming up. S&P 500 ended up the day up 0.8%. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Turn out the lights.
All right, Charlie.
The party's over. They say that all.
Nice.
I like that intro.
Nice.
Because this Bloomberg Businessweek headline really got my attention because I'm all about, you flexing the corporate Amex card or whatever we're using at the time here. Year of 800, and I got a story about that. Solomon Smith Barney.
Ooh, some stories, I'm sure. Please tell us.
Crushing. Era of $800 dinners and luxury car bonuses is over at Salesforce. Joe Weber joins us. He's the editor of Bloomberg Businessweek, joining us here in our Bloomberg Interactive Broker studio. Drake Bennett, technology reporter, Bloomberg Businessweek, on Zoom from Bloomberg headquarters in New York. And Brody Ford, apparently somewhere, enterprise reporter, Bloomberg News, on the phone somewhere, undetermined, keeping a secret location.
Stay mysterious.
Great story, Joel. I mean, first of all, it's Salesforce.com. Everybody cares about Salesforce.com, Benioff, all that kind of stuff. But, luxury car bonuses?
It was a great time to be in tech sales. And actually the pandemic even made that even more so, because they just staffed up and kept selling. But then some things started to change, and I've always been really fascinated with Salesforce as a business, and it has become expansive and actually really created a whole industry, and that's a big credit to its founder, Mark Benioff. But this is sort of a new era for Salesforce. Tell us more, Brody.
Yeah, at some point, you got to stop spending like a startup. And that's what investors told Salesforce this year. They pretty much said that, hey, if you can't keep growing sales the same way, you have to start cutting costs. And yeah, like the headline says, I mean, some of these costs are $800 dinners. And the more mundane stuff is the insane commissions you can get off of selling things. I mean, I always say that I picked the wrong industry because I would speak to people who are about my age, got into the same, at the same time, they're now working in tech sales, making $400,000, $500,000 without a whole lot of experience. I mean, it was just gangbusters. I mean, Benioff told me that selling software was never easy, except for during COVID. It was just firing on all cylinders.
So what's happened? What's the change like within the company?
Yeah, they've just had to get more serious. I mean, the obvious one is firing 10,000 people, right? I mean, that's the one that most of us read about, but it's even simple stuff like, okay, now when you sell a piece of software, you can't have 10 people all get a commission off of that, right? You can't, as you said, have the $800 dinners. It's really trying to pare back all these expenses that made it such a distinctively fun place to work in many ways.
2023 has been, even for the technology companies, a year of cutting costs. And I think the greatest example of that, or the one I think investors might know the most, is Meta.
Yeah.
The stock just ripping this year on, Zuckerberg saying, we're not going to spend like drunken sailors on this metaverse. We're going to actually focus on costs. And I guess that's the story.
It tends to
Salesforce
go
too.
well with investors when you can bring in that cost and show that there's a return on investment. But it can come at the expense of culture. So Drake, I want to just bring you in here and also just talk about the industry, because ultimately what we're talking about is something that Benioff pulled out of his brain and then created, and that's SaaS. And so talk to us about just the economics of a business, a software sales business, where you no longer have to have the typical kind of infrastructure, and what that kind of can accomplish for investors and companies.
I mean, Salesforce is I mean, I think for a lot of people, it's not like when people think about Silicon Valley, Salesforce isn't necessarily the first company that comes to mind. And there's this idea that Silicon Valley tells about itself to the world, which is that the value of its, all of its wealth and its growth comes from these like brilliant ideas that software engineers have. But there's kind of this other explanation for at least a lot of the recent growth there, which is these armies of salespeople that companies have. And Salesforce really pioneered this. And as you point out, it's linked to this business model that they basically pioneered, which is, rather than selling software, on like a CD-ROM or a disk, like you put it on the cloud, and then you go out and you sell.
Revolutionary.
Yeah, I mean, software as a service is SaaS is this thing that everyone's heard now, without even kind of like fully realizing what non-SaaS is. So there's all these companies that are basically modeled on Salesforce, which is like you sell enterprise software, you sell software to other companies, and you put it on the cloud.
Other salespeople.
Right, and so there was this weird dynamic. Like Salesforce grew an enormous amount in the last few years, and especially during COVID. And what it was basically doing was selling these software leases to other companies that were using these tools for their growing sales forces. So it was kind of this. Ponzi scheme is an incorrect term, but it's basically like this weird dynamic where like everyone was growing, and so Salesforce was growing, and then basically at a certain point that reversed. And so what you saw was that as sort of all these other software companies were shrinking, Salesforce had to shrink too. And so, part of what we were writing about was just this aspect of Silicon Valley that people don't really think about that much, and how it sort of shapes the culture of this company and how it shapes the culture of Silicon Valley more broadly.
Brody, I wanted to bring you back into this conversation. And speaking of salespeople, y'all were writing about how some salespeople were relying on aggression and pressure to close those deals, but also you just need to get people and customers to like you. Walk us through anecdotally in the reporting whenever you were speaking to people about how sort of this process works.
It's a really funny dynamic that comes back to the business model, because SaaS software, it's a recurring contract. Essentially, you need people to stick around. You think about car sales, door-to-door sales, this kind of old thing. You're thinking of real hyped-up jocks trying to get you to sign the paper, almost like physical coercion, right? But this is more like they just kind of got an army of, like, for lack of a better term, frat boys. Just people with nice smiles that would just kind of show up and like, hey, how's it going? The software going good? You need any help? All right, cool. We're here when you need us.
Wow.
What kind of sales?
And there were just armies of them. They call it the clown car approach, because one person would pull up with the sales software, one person had Slack, one person had the data viz software, and they were all getting paid really good. But again, at some point, companies, when the interest rates started rising, there had been years of buying software gangbusters. The CFO started saying, well, why do we have all these smiles hanging around selling us millions of dollars in software? How did this happen? And so they really cut off the spigot of wealth. And that's really why we saw the style of sales here start to break down a little bit. And it's not just Salesforce. This is really an industry-wide phenomenon.
But what does it look like and feel like at Salesforce, Brody?
So our favorite source in this story, we call him Kenny because it's an alias. He still works there. He said when he first joined, it was all parties. It was great. His phrase now kind of sucks. It's just it's harder than it used to be. You're signing less big deals. Your boss is calling all the time. If you don't it used to be that you could not make quota for like a year and a half, 2 years. Maybe then you'd get fired. Now if you don't make quota in a quarter or two, you're out of there. You got leaderboards. People are more cutthroat because not everybody can share commissions. It looks more like that kind of car sales environment, right? It looks more like the old school cutthroat. There's a movie Drake likes to reference about when sales gets hard. What is it?
Glengarry Glen Ross.
Yes. A, B,
Yes.
C. Always be closing.
Is it Alec Baldwin?
Yep.
Yeah.
So Businessweek had a little fun with that one. We were playing around with it with the headlines and the cover lines, and it became the headline inside the magazine. Always be cost cutting. There's a new C in town. But Jake, tell us more about the death of the salesman. We talked about that years ago, decades ago, because Arthur Miller wrote a hell of a play. Has that era come for sales, software, and tech sales now?
I think to a certain extent. I mean, one of the things that I loved getting into in the story was just this whole culture of software sales, which, they're these sort of online influencers who would give you these kind of slightly scammy courses about like everything you need to know about software sales. There was just, and Salesforce sort of offered this whole curriculum about, this kind of like Dale Carnegie style, sales education. And I think a lot of that is froth, and a lot of those skills probably weren't that useful. As Brody pointed out, there was a sort of a self-perpetuating cycle to this, where like if you hired more people, you needed more Salesforce software leases, and so it kind of didn't matter who was selling it to you. And so it may be the case that you don't need quite as many people out there selling it, and you don't need to pay them that well. And
guys, I don't know what Brody, is this kind of the new normal now? I mean, is the party over when you talk to these people?
I think that's what we're seeing here. I think we're seeing this is all a big part of big tech losing its shine, right? In the last couple of years, we saw big tech losing its shine regulatory. They said, wait, this might not be good for us psychologically. I think this year we see big tech lose its shine economically. That, wait a second, these business models are not impervious. They're not bulletproof. At some point, these jobs that were the golden standard have to become normal, right? I mean, I don't know, like working at GE in 1960 was probably the golden standard. And I think we're starting to see these tech giants become a more standard part of the economy and lose their kind of special edge in terms of being a great job. But they're still, you can still make some money. It's still a good place to work, but it's not what it used to be.
Well, one of my favorite details was like they're talking a lot about how they're going to use AI, and Mark Benioff loves talking about AI.
There it is.
But one of the things they're actually using for right now is basically finding when sales people are kind of like goosing their numbers and cheating. So it seems like, that's the new reality.
So what do we think Mark Benioff's company looks like a year or two from now? Like, shed the tech sales guys and that cushy tech job. Like what does a more hardcore Salesforce look and feel like, since it's been such a cuddly, friendly place up until now?
I'm sure this is weird to hear for a tech company, but they're hiring engineers. That's actually what their main focus is now. Is I think they're really trying to invest in new products and figuring out where that next realm of growth is, right? I mean, the products that got them here are pretty mature at this point. And as Drake mentioned, like all companies, they're looking to AI to really accelerate it. I don't know if you've seen Matthew McConaughey on TV wearing the cowboy outfit, talking a bit about AI and who's the sheriff in town. That's Salesforce. I'm not sure I get what it means either, but that's Salesforce.
Matthew McConaughey.
So just final question, which Drake, I want to bring it back to you. You've written about a lot of companies, different strategies, different sectors, different industries. If you could, cast the movie for the Salesforce version of the story, like do some casting for us. Who's the salesperson of the year?
The salesperson you mean like who's Kenny?
Yeah,
like who would play
let's
Kenny?
cast Kenny.
Who was that guy? Giovanni Ribisi? Was in like is that like too obscure from like Boiler Room?
No, he's awesome.
Yeah.
I love that you have
high energy.
That very quick.
I'm impressed.
I don't know. Yeah. Just like nice, sort of like almost pathologically upbeat kind of person.
Yeah.
Just indefatigable, stellar.
And what about Brody? What about Benioff in the movie version of your story?
He'd probably agree to do it himself.
Yeah, that's right. That's right.
Anybody.
I mean, how does he feel about the business? I mean, everything's performance is doing great. So how did your interactions with him? What do you have to say?
I think he is very aware that they had a long stretch of bad headlines this year. His message right now is that, they always say that it's an Ohana over there. That's his big phrase.
Yep.
What he gave to me was, look, it's Ohana 2.0.
Right.
It's still there,
Yep.
But we had to.
All right, Brody, we're going to have to leave it there just for time. Joel Weber, Drake Bennett, Brody Ford, Bloomberg Businessweek. You can check that out on the newsstands. I got that great story.
The cover
on
issue,
Elon
too.
The cover, absolutely. Some good stuff. Check that out. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Jess, Menton, Paul Sweeney here in the Bloomberg Interactive Broker Studio, filling in for Carol Massar and Tim Stenovec, who do have the day off. Not sure who's who's Carol, who's Tim here, Paul. But
Exactly.
looking at the S&P 500 today, up 0.7%. If you look on a weekly basis, a little changed. But this does come following a 5-week winning streak that was its longest since June. But who better to chat with us about their market outlook moving forward? Kristof Gleich, President and Chief Investment Officer at Harbor Capital Advisors, who's actually here in the Bloomberg Interactive Broker Studio. I know Paul always loves when people are here in office with us to discuss his outlook and also his investment strategy. I want to pick your brain now that we are into year end here. What's your take as far as positioning wise going into next week ahead of the Fed decision?
Well, thank you so much. It's great to be here in person and live. I think this year has surprised a lot of people. It's caught a lot of investors offside. If you think back where we were 12 months ago, supposedly now we should be 3 or 4 rate cuts in as the Fed is continuing to try and stimulate an economy coming out of a recession. We know how that sort of playbook played out. And I think what surprised investors is how resilient growth has been this year, how resilient markets have been this year. And, at the moment, your colleague read out, there's a lot of green on the screens. Camp soft landing is winning, and it's very much risk on environments at the moment, as it has been in the last 5 weeks.
How do you think about valuation here? Because I think that I'm just looking at my chart of the S&P 500, and boy, that was a heck of a November there. And I'm wondering if we've kind of gotten a little bit too over our skis a little bit in terms of valuation. How do you guys think about that?
So I'd say trying to time markets on a short-term basis, what's going to happen this week or that is pretty difficult to do. I think valuations here, I'd probably say fair. And so we would recommend having a good allocation to equities for investors that are ultimately investing for the long term. Of course, it's a market of many different regions, many different market capitalization. I think there are areas of the market that are looking pretty cheap right now.
You talk about in some of the notes you sent us, don't hide out in cash. We've seen the fury into money market funds over the past year being at a record here. What's your view on as far as what's the catalyst when people argue about, we're going to put our money in money market funds for the yield, but then if you have these double-digit gains in these major indexes, how do you square that away? And at what point does that move out of money market funds and then into equities?
So I think that if you look at any long-term investment chart over any reasonable time horizon, there's always a squiggly line at the bottom in decay, and that's always cash. Cash is the worst performing asset class over any reasonable time horizon. So what we would say is hold enough liquidity for your immediate liquidity needs as an investor and what you're comfortable with. As it pertains to what's going to create some of that cash to come out, there's $7 trillion. $7 trillion is a huge number sat in money market funds. And I think in certain areas, we've seen investors wait on the sidelines for this supposed recession that hasn't come. And I think the longer that we continue with this soft landing scenario at the moment, it's going to pull more investors. They're going to begin to start putting money to work, and we're already beginning to see that. And specifically around small cap as well, I think it's a pretty attractive entry point right now.
All right,
small
that's
caps.
where I wanted to go.
There we go.
I hear small caps, mid caps, small caps, but man, that's a tough place to make money historically. Is it a valuation call that attracts you to the small cap space? Is it just that maybe they haven't performed? Kind of, how do you think about that?
So the answer that we hear most often, and we actually asked this, we held our global market outlook call, and the theme was in search of bright spots yesterday, and we asked our clients around small cap, and the answer that got the biggest response was, waiting for the recession before allocating to the asset class coming out of the other side. Okay, there's a lot to unpack there. Recessions are incredibly hard to kind of forecast and predict exactly, but we get it. We understand that mentality. If you look at small caps, they've effectively been in a recession for the last 2 years. Some colleagues of yours did some great analysis on the Bloomberg terminal the other day, and I saw small caps are currently going through their second longest drawdown in history. It's only coming out of the tech bubble. You can compare to this. So if you look at small caps, they are off in the region of 30 to 40% off their peak. And you've begun to see a broadening of the markets. You've begun to see a bid for small caps, and I think investors are already beginning to come back in.
Yeah, that's really interesting that you brought that up, because it's the worst 3-year span relative to the S&P 500 when you're looking at the Russell since the late 1990s and the turn of the century. What sectors in particular, when you're looking at small caps, are attractive to you?
So the way that we work at Harbor Capital is we work with boutique money managers across the world that we believe are experts in their own domain. So they do all the day-to-day stock selection. A couple of things I'd say about small cap is it's an area that we think is ripe for skilled active managers to add value. We think a skilled active manager in small cap can add 3 or 4% net of fees. And ultimately, you're outsourcing that day-to-day stock selection to those managers. I think some of our managers at the moment, particularly, again, this is a bit of a contrarian call, like biotech has been absolutely hammered in that space. But there is some optimism building. You can't fall too much further from the basement. And potentially what we might see is some more M&A in the healthcare sector that might put a bid on some of these biotech names. So that was one of the themes that came out of our Outlook call yesterday.
How about the ETF space? That's getting a ton of cash. How do you guys get exposure there?
So we have, we've been in the ETFs now for 2 years. We launched 2 years ago. We now have 14 ETFs. We have about $1.3 billion out of our $50 billion is in actively managed ETFs. And we think, a lot of the innovation, a lot of the money flows are going to continue to go to ETFs, especially for taxable clients.
All right. It's interesting. I mean, that's just kind of where the capital's flowing, so you got to have exposure there, right?
Yeah, absolutely. And specifically for us, where we've seen money put to work in our ETF lineup, one of our flagship strategies, the ticker is WIN, WINN. It's run by Jennison here in New York. It's a large cap growth, concentrated, fully active, transparent portfolio. And it's done phenomenally well. It's up 47% or so this year and has outperformed its respective benchmark by about 1,000 basis points.
Well, good stop there. Good start. Kristof Gleich, thanks so much for joining us. Kristof is the President and Chief Investment Officer of Harbor Capital Advisors. They got about $50 billion in assets under management. And he joined us here in our Bloomberg Interactive Broker studio, so he gets a special star there. S&P 500 up 0.75%. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.